All right. Thank you, everyone, for dialing in. I'm really thrilled to introduce you to David Bassanese from Betashares. Now, for some of our older members will actually remember a session that David did a couple of years ago, and there was some terrific feedback about that session. David's a chief economist at Betashares. It's a big title considering they hold, I think it's 37 billion of funds under administration right now, David, if I've got that number correct.
Yes, it's
it's not insignificant.
Yeah.
Well, congratulations on the growth. And from our end, a lot of our members have exposure to Betashares, so we thought it'd be beneficial to have you on today and get a high level understanding as to where investment markets are more broadly and where you think we're positioned.
No worries. No, great to be with you, James.
Let's get started, if I may. I'd love to have a chat with you about the state of domestic interest rates, the main drivers, and perhaps your best guesses as to when we might see some reprieve.
Look, obviously the main driver at the moment, of course, is the increase in inflation we had post-COVID. I mean, we had goods inflation pick up, then we had service inflation pick up. The Reserve Bank responded by raising rates, wanting to make sure the economy did slow down and that inflation wasn't sustained. The good news is that inflation peaked in late 22. It's been coming down. It's still above the RBA's target, but as we get closer to that target, they are going to start to take the foot off the brake. I mean, interest rates are at restrictive levels. So my expectation is we will get rate cuts later this year, probably around August or September. And I'm actually penciling in 2 rate cuts this year on the back of further declines in inflation back toward that 2 to 3% target.
We've spoken with this with our members. We speak a lot about this with our members, which is the idea that we're watching headline CPI and the way it rose up almost 8% and then coming down quite sharply. I'm talking about the analogy of the way that you land a plane. If you're landing a plane, you don't go straight down to very steeply to ground level and then try to pull it up to land. You come in slowly, and you as you approach the altitude that you want to land at, you have to cruise into it rather than just nailing it. So I guess that, if I'm understanding this correctly, that's a compelling argument for why interest rates might need to move a little bit sooner than if we were just content to just see it crash down to the 2 to 3% range and then make do from there.
Yeah, like I guess to apply it to the economy, I mean, you could wait until inflation was back to 2 to 3% and then cut rates from what is 4.35% at the moment, the official cash rate, all the way back to what the RBA think is normal, which is 2.5%. You could cut rates 200 basis points in one meeting once inflation's back into target, but they don't do that. As the evidence moves in support of the idea that inflation's coming down, they gradually move rates back ahead of that. So ideally, what you want is that as inflation moves back into that target band, you actually have sort of gradually moved interest rates back to a more normal level. And a more normal level in Australia today is around about 2.5–3%. So, we are above normal at the moment.
Mm-hmm. Yeah, thank you. What about if we move across to the current state of equity markets? If perhaps we start domestically, how do you see the Australian Stock Exchange, for example, or the ASX 200? How do you think those indexes are valued?
Look, it's not bad value. I mean, I think globally what we're seeing is that outside of the large cap US technology companies, the Magnificent Seven, as they're called now, as wrapped up in our NASDAQ ETF, for example, the NASDAQ 100, they are looking pricey from a long run perspective, not ridiculously pricey, certainly nowhere near. Maybe some of your older, clients may remember the dot-com bubble of 2000. I mean, the NASDAQ then was trading at 70 times earnings. Today, it's trading about 33 times earnings. So that is but that's still above average. The rest of the world, including Australia, is actually trading at, I would think, fair value to even a little bit cheap. Emerging markets are cheap. China's definitely sort of cheap. We're trading, probably in the sort of fair value range at the moment, around about 16.5 times earnings, in expectation of a recovery in corporate earnings. And so just quickly in Australia, I mean, we had, when Russia invaded the Ukraine a couple of years ago, we had that surge in gas and energy oil prices. It flowed through to resource company earnings in Australia. We had a big uplift in earnings. We outperformed in 22, but those prices have come back down again, and we've been basically underperforming global markets really since late 22. Overall, we've been our market has been in this messy sideways range, for a couple of years actually. And the good news is that just recently we've broken out of that range. And so we are looking as if we're moving to the upside as earnings are starting to, we're getting through that down period of earnings because of that correction back in energy prices. We're looking the RBA, as mentioned, eventually cutting rates. So the economy should start to improve later this year, which is going to flow through to corporate earnings. So I think our market now is starting to anticipate some recovery in the economy, some recovery in corporate earnings. And that's why it's sort of breaking out to the top side. So it's doing okay. Hasn't been doing, but if you look, obviously in the US market, it's been doing a lot better just in the last couple of years.
Yeah, you make some great points with the NASDAQ in particular and the tremendous growth that's had. We've a lot of our members have got a HNDQ in their portfolios, a hedged NASDAQ position, and we're lucky enough to get into that at a really good point. It's been a significant driver of wealth. Thinking about the classic domestic question that we have, which is around, do you invest right now in domestic equities or international equities? And obviously international is spectacularly broad. But if you were forced with a 5-year outlook between investing domestically and investing internationally, do you have a strong view there on which way you might go?
Look, if you're talking, global markets are, it's a wide gamut, right? If you're talking about the broad overall so will Australia outperform global equities, broadly speaking, over the next 5 years? I actually think it's pretty much a mixed picture. So I wouldn't have a strong view that we're going to outperform or underperform. At the moment, really since the GFC over a decade ago, it has been US technology companies that have dominated. So everything else is more or less underperformed, including Australia. Now, can they continue to outperform? Look, as I said, they've done so well for so long. It might be that the rest of the world sort of catches up, but I wouldn't necessarily hang my hat on that happening because the technology. Look at Microsoft just as an example. A large company. We thought it was dead and buried when the internet came along. It's reinvented itself. It's now one of the most highly capitalized companies in the world. It's had a renaissance. And so, these companies have learnt to pivot, learnt to retain, very good businesses in the face of massive technological change. So I wouldn't necessarily say one is going to do better than the other because of that sort of balanced picture at the moment. Valuations are rich, but it's maybe deservedly so in the tech sector because of their earnings performance.
Well, thank you for the answer, and that brings me perfectly to my next question, which is around the NASDAQ in particular. We've seen a tremendous amount of growth. As I mentioned before, a lot of our members have pretty reasonable positions into the tech market through ETFs. And a common question that we're getting right now is, at what point do we start to deleverage that position and say, hey, we well and truly got the best of that? And what's your take on the matter? Do you think that those positions, if we take a medium or long-term view, do we think that they might succumb to the significant, I think it's a 33 times multiple you were describing before?
Yes. Yeah. So, look, at the moment, the macro backdrop does not warrant, undue concern about the tech sector. We've got the US economy, shrugging off fears of recession. The US economy has been very resilient. The Federal Reserve over there, the US central bank, is getting closer to starting to cut interest rates. Lower bond yields are usually good for the technology sector. So the macro backdrop is actually still favourable for the technology sector and including the NASDAQ. And so I don't really see a catalyst for a major correction. The one big risk would be a rerun of 22, when central bank, if the Federal Reserve suddenly decided, we can't cut interest rates. In fact, we may need to raise rates because inflation is staying stubbornly high. then the NASDAQ is at high risk of a correction, at least, maybe a 10 to 15% correction. But at the moment, inflation's coming down. Central banks are talking about rate cuts. So I think it can hold in pretty well. So the only question is, maybe some cheaper parts of global markets like emerging markets, Europe, even Australia to an extent, maybe they catch up. Maybe they have a period of stronger performance just because they look relatively weak. Now, that doesn't mean the NASDAQ is going to fall in a hole. It just may mean that it just doesn't rise as quickly over the next little while. But so I'm still, pretty comfortable with the sort of NASDAQ outlook, notwithstanding, that seem to be a little bit expensive relative to, say, other parts of the world at the moment.
Well answered. My last question, please, is around the considerations associated with market cap. As we've seen, of course, we've seen it with the Magnificent Seven, but also more broadly, we're really starting to see on a comparative level, like your small caps, even small and mids, are undervalued as a function of of large cap equities. And that's a trend that has been going for a few years, and it's really been magnified of late. Is there merit, do you think, in considering whether it's a rebalance or a tilt toward those smaller mid caps to I guess soften our exposure to the top end there?
Yeah, I think that's true. I mean, just in terms of you're right. The small caps, even though, what's been interesting, even though over the past year, we've gone from fearing a global recession to deal with inflation. That was the big fear, and it turns out that economic growth is holding up better than expected. But it hasn't come at the cost of inflation staying too high. Inflation is still coming down. So we've almost got this Goldilocks sort of scenario at the moment where inflation's coming down, economic growth is holding up. And you would think small caps would roar in that environment, would do very well. But at the moment, there's been that pull of the large cap US technology companies, and that's sort of still a focus of attention. Of course, the one thing we haven't mentioned is the new, I guess, tailwind for that area is artificial intelligence, the whole AI boom. So that's given, not that they needed it, but it's given those large cap companies even more, given investors more optimism. But yeah, I would think as confidence of the global economy avoiding recession, economic growth improving outside of the US, and even in Australia starting to improve, we may well see catch up in the smaller mid cap part of the market because it looks relatively cheap. And I think as investors take on more confidence, more risk, they may look to look out some of the areas outside of the large cap area. And I think just generally, we are looking at historically quite concentrated levels of. At the moment, the handful of US large cap tech companies dominate. They think they count for something like 25% of the S&P 500 index. It's something we haven't seen since the early 1970s. So the level of market concentration is at record levels. So again, I'm not saying they're going to fall in a hole, but I'm just saying it may mean that the rest of the market can catch up. So having a bit more diversity, increasing your exposure outside of those large cap technology companies, is probably a prudent move.
Yeah, thank you very much. I reflect back on my very early years in financial advice from 2006, 2007, and reading about exchange traded funds, these ETFs, and familiarizing myself with them. And the one criticism at the time seemed to be this concern that if everyone piles their money into exchange traded funds, you naturally get this effect of those large caps having heaps more money tipped into them, which of course increases demand, and then commensurately price will increase and so on. And I think about the last almost 20 years since I was reading that sort of text, and ETFs have blown up in a way that perhaps very few, maybe yourself accepted, could have anticipated. Do you think that, notwithstanding that the ETF, the range of products available for ETFs has grown immensurately too, do you think that ETF acquisition around the world is contributing to that significantly? The idea that large caps become larger just by volition of being large caps?
No, I don't think so. And because firstly, a lot of the flow into ETFs, exchange traded funds, passive investing, has come at the expense of unlisted active management funds. So I don't think there's been a overall net increase in investment in equities. It's just the way in which people invest is shifting. That's the main story. Yes, ETFs are booming, but it's coming at the expense of, many active managers, many household names out there in Australia and in the US are actually under a lot of pressure, fee pressure. We find a lot of active managers on average, struggle to outperform the benchmark. And so if they're charging a high premium,
have for a long time.
So I won't get into that, but that's the main argument. I guess the other point is that there are ETFs covering all manner of things. Yes, there are ETFs covering market cap indices, but there are ETFs offering more value exposures. So there's lots of different ways to invest in the equity market, and it's not just all flowing into the big large cap area.
Yeah, thank you very much.
We can't. The thing driving the tech boom is just the innovation. The growth of the internet, the growth of online transactions. We're spending a lot more time on social media and not watching TV, as much. So these massive technological trends is what's driving the boom, not ETFs per se.
Yeah, I think that's a very reasonable thing to say. David, thank you so much for your time today. It's always a pleasure to have a chat with you, and I'm certain that we're going to receive more great feedback from this session. So, mate, cheers, happy Friday, and looking forward to chatting to you again soon.
Great to be with you all. Bye for now.
All the best.